Good evening, everyone. I hope you're doing well. It's been a crazy 24 hours or so in the markets. I won't get a chance to cover everything I'd like to talk about, but let's talk about Australia's inflation numbers, delve into some of the quite scary stats, I think. Look at the record high in the Australian market, the US Federal Reserve interest rate decision or lack thereof, but there's more coming, and just the picture for interest rates going forward. So, firstly, let's have a look at Australia's inflation numbers. So this is the monthly CPI indicator. And let me just hide that, get it out of the way. So the narrative at the moment is that the RBA is done the RBA is done raising interest rates, that all is fine, inflation's coming down, et cetera, et cetera. So what I've done is I've taken about 3 years of data here. This is the monthly inflation indicator, the CPI indicator. And the red line that I've drawn here is the maximum target that the RBA is supposed to be adhering to. So the RBA's goal is to keep inflation between 2 to 3%. And I've drawn a red line at the 3% maximum, so they should not be allowing inflation to be above 3%. And as you can see, since the start of 2022, in fact, late 2021, inflation got as high as 8.4% at the peak. And of course, at the start of 2023, inflation started coming down. And you can see over the last 6 months, inflation bottomed 6 months ago. And since then, it looks like it's been trending back up. Now, I'm not suggesting it's going to go straight back up to 8, 9%. We're probably going to have a period of 12 to 18 months where inflation is relatively low. But keep in mind, all the inflation we've had, why would we want prices to go up another 4% on top of how much they've already gone up? And even if the RBA achieves its target, getting inflation to 3%, is that what you want? Do you want your prices to go up another 3% every year on top of how much they've already gone up? Now, let's have a look and compare that to the US. So the US has an inflation target of 2%, a ceiling of 2%. And I'll zoom back out on this chart so we can have a look at a bit of a comparison in a moment. But you can see, as with what's happened in Australia's inflation numbers, you can see that about a year ago, US inflation bottomed at about 3%, and it's just been going sideways. It's never come down to even 2.9%, let alone below 2%, which is the Federal Reserve's target. So if we zoom out on this chart, and my apologies, I'm using a new service here, you can see similar trend, but Australia's behind. US inflation has come down. It peaked sooner than ours, probably about 9 months sooner than ours, come down sharply. It fell more than ours, and it's been at this lower base level for longer. And you can see US inflation has been tracking sideways as well for probably 10 or 11 months. And the Australian number is doing something similar. I've talked in the past about the importance of the price of oil on inflation. So what I've done is I've taken these two graphs and I've put the price of oil in Australian dollars below and the price of oil in US dollars. So you can see that the price of oil goes, and it's not just the petrol you put in your car. Remember, oil factors into the price of many, many things across the economy. Think about all the things you buy that aren't made in Australia, or aren't even if they are made in Australia, they're not made in the city that you live in. So we need oil-powered machines to dig up all the raw materials to make the phone or computer that you're watching this on. We need oil-powered machines to ship around all the products, like the shirt that I'm wearing here. This was not made in Australia, not made in the city that I live in. It has to be shipped around the world. So you can see it's a little bit hard because I know these charts are a bit small, but you can see the price of oil moves up and then it feeds into the inflation numbers about 6 months later or so as the price of those goods rise along with the cost of oil, the cost to transport these items. Um, and you can see once oil peaked in May of 2022, we saw oil decline 45% from the high in May 2022 to about the same time in 2023. So over the course of a year, massive decline in the price of oil. And that, of course, brought, it's somewhat correlated, I would argue, it brought inflation down. You can see the same thing with, I've got the US dollar price of oil here, the Australian dollar price of oil here, and you can see that inflation's come down, but now oil's just going sideways because oil has stopped going down, partly a factor in inflation. You can see the inflation numbers are going sideways as well. Now, you might say, well, John, what the hell's going on? Why is the RBA talking about? So let's go across to the RBA rate tracker. So this is, in short, this is market pricing of what the market thinks the RBA is going to do with interest rates. And you can see that as of 31st of July, there is now a 95% chance that at the meeting next week, they don't do anything with interest rates, and there's a 5% chance that they decrease interest rates. And this graph here will show you from July 2024 out to December 2025, so about 18 months of data. This dotted blue line here represents where the RBA currently has interest rates at 4.35%, and these bars here represent where the market is pricing RBA interest rates to be. And you can see the market now thinks there's a 0% chance of another rate increase, and that the rate cuts probably start in December or January, with further rate cuts to follow. And you might be saying, well, John, why the hell is the RBA cutting rates when inflation has never, for starters, inflation spent about, what's that, 2, 3 years above the RBA's maximum target, well above the target for quite more than double the target for at least 18 months. And it's bottoming here. It looks from the data. This is the government's data. It looks like it's bottoming here and it's trending back up. So why would they be cutting rates? Well, one of the reasons is our economy is in a recession. We are in a per capita recession, so a per person recession. And if we scroll down and look at some of the data here, Australia is negative 1.3% year on year growth. I don't know why that's popped up another screen. My apologies. Probably because I tried to click on the chart. So if you measure the economy per person, we're already in recession. So that might have something to do with why the government is allowing so many people to come to Australia, because more people come in, the GDP grows on the headline number, but we're not actually growing. So the economy is already um, in trouble, and we can have a look at some more data on that a bit later. So now let's go to the Australian Bureau of Statistics website, and my apologies, it's just refreshing and loading here. So we're not using any conspiracy websites, we're just looking at government data, and there's a few things I wanted to show you in the consumer price index, or the inflation calculation. And it's probably important to distinguish the two, because inflation is not the same as the consumer price index measured. There are multiple ways of measuring it, and I'm going to talk about some of the ways the government understates. I don't agree with the government's numbers, but let's go off the government's numbers. So what I think the RBA has done is, for starters, they haven't raised interest rates as much as many of the other central banks. Um, Let me just see if I can go back to that. So, I mean, America is at, the Federal Reserve, the US Federal Reserve is at 5.5% for their maximum target interest rate. So Australia didn't raise rates as much. And here's something I want to show you. This is, again, from the Australian Bureau of Statistics, from the official government stats on inflation. So we have seen Australian inflation come down somewhat. Let me see if I can zoom in on that again so we can look at it. So yes, we've seen Australian inflation come down, but is that because the RBA's done anything about it? Have they raised rates enough? I would say not. And here, where we look at the non-tradables, inflation remains higher than tradables. So non-tradables. So what they're doing here in English is they're separating items that, like, say something like a TV or the phone that you're watching this video on, that's not manufactured in Australia. So the Australian government, the Reserve Bank of Australia, and domestic factors going on in Australia really have no or very little influence on the price of the computer, the TV, the mobile phone, the clothes you're wearing, the shoes that you're wearing, etc., because those items are manufactured overseas. So most of the cost is occurring over there. So what the government is saying here is that tradables, so tradable items are things like the mobile phone made overseas, or the clothes you're wearing, etc. Note that that inflation rate has fallen from 8.7% down to 0.9% annualized in March, and in the June quarter it's at 1.5%. So what's happened is all the other central banks around the world have raised interest rates, or not all of them, sorry, but some of the other major ones raised interest rates as much or more than the Reserve Bank of Australia, and they raised them faster and sooner. So global inflation, like the oil price, which the Reserve Bank of Australia has no control over, we saw the oil price come down 45%. So that's put downward pressure on global inflation, but that has nothing to do with the RBA or anything our government's done. That's just global factors. So that inflation rate is running at 1.5%. But when we look at the domestic inflation, so I'm trying to highlight it. Non-tradables includes goods and service that are mostly influenced by domestic factors. So factors within Australia, within the somewhat control of the RBA and the Australian government. That inflation rate is still running at 5%. It has not fallen. So it was 5% in March 2024. The Australian government reports these more detailed numbers quarterly, not monthly. And for the June quarter, we just got the data yesterday. It's still 5%. The RBA's target is 2 to 3% inflation. Why isn't this of concern to them? They should be, of course, they're not going to do this. We just had a look at the data, but they should be very concerned about that and they should be raising rates. So it shows that they've really made very little progress. They've done nothing. I mean, raising interest rates to 4.35%, that's still a ridiculously low rate of interest. We've just seen the Australian stock market hit an all-time record high price. We've seen real estate in this country, which is, I mean, our real estate market is a $10 trillion market. And it's for most households, for most working class folks, their biggest expense is either their mortgage or their rent. For a lot of people, I know there's some people who are older, they've paid off their house, etc. But for a lot of people in Australia, their house or their apartment is their biggest expense. And we're seeing all-time record high real estate prices and skyrocketing rents. I mean, rents are going up at double the over rents are still going up at 7.4%, so double the overall inflation rate. Does that sound like they've done enough to, because obviously rents in Australia don't really have much to do with what's going on in America or Europe. It's more of a domestic factor. So those are very important prices that make up a significant chunk of people's income. So why isn't the RBA concerned that I mean, they've really made, I would say, very little to no progress. Okay, so the next thing that I wanted to show you, and this is one of the many ways that I think the government is understating the true rate of inflation, and this isn't even the biggest issue, but this is just a new one that's coming up, and I think we're going to see more of. This is again from the Australian Bureau of Statistics website. You can see that the Energy Bill Relief Fund rebates continue to reduce electricity bills. So, for example, in Queensland, we're getting $1,000 rebates on our electricity bill, so $1,000 off our electricity bill. So the Australian Bureau of Statistics points out that excluding the Energy Bill Relief Fund rebates, prices for electricity would have increased by 14.6% in the 12 months to the June 2024 quarter, which is what we just said. So, in other words, over the last year, electricity prices, the cost of electricity, has actually gone up 14.6%. But keep in mind, because everyone is getting a rebate, so here they show you on the chart here, they show the index of 100. So you can see the price of electricity has gone up, but they're saying, no, 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 because you're getting a rebate. So because here's the including government rebates amounts, uh, it seems to be, and we'll have to wait to see to get more information on this, but it seems as though they're saying, okay, well, yeah, electricity went up 12% or 14.6%, but you got a rebate. So therefore, the price only went up 6% because you didn't pay the 14% increase because you got $1,000 off your bill. So as governments hand out more of these rebates, and I expect more of this sort of thing to come because they clearly can't stop inflation by raising interest rates high enough because we have a real estate hyper bubble. The economy is already in a per capita recession. Uh, the banks would be in big trouble. So I think we're going to see more of these rebates, more handouts, and they'll say, "Oh, well, you didn't actually pay," because it's remember they're not measuring inflation; they're measuring the consumer price index, the price that you pay, not the actual inflation, just the price you pay. So. If someone wants to fact check me on that, I'm happy to admit I'm wrong, but I think that's very dodgy, and it's not entirely clear how they're calculating it. But I mean, the ABS does go to their way to separate the actual cost of electricity and then including the electricity rebates. So I won't harp on that for too long. Now let's go across and have a look at how the markets reacted to the inflation number yesterday, because you'd think looking at those numbers that, oh gee, we should be concerned about inflation. And my apologies, I know the chart is having to reload here. So this is a chart. So the shortest duration of government bond the shortest duration of bond that the Australian government issues is 1 year, to my knowledge anyway, unless there's some kind of financing going on behind the scenes. But the point being is this is the interest rate on 1 year Australian government debt. Have a look at that red candle. And when my computer decides to unfreeze itself, my apologies, I've loaded up multiple charting screens. Have a look at that massive red down candle that occurred yesterday as the interest rate on 1 year Australian government debt collapsed. And that's because the market is going, hey, well, these guys aren't going to raise interest rates anymore. So down goes the interest rate, keeping in mind that if you're a client of mine and you're following my advice, our biggest position is bonds. And when you see interest rates go down, that means bond prices are going up. So this is good for our strategy. It's not good for the country or for the inflation fight, but you can see the interest rate was on an uptrend because inflation was pretty bad. And have a look at what happened over the last couple of days. Big breakdown. That's a technical breakdown. That's an indication that any uptrend in interest rates is done for the time being. Yes, maybe there'll be some recovery, but that tells you what the market thinks about what's going on. Like, so the market is pretty much saying, hey, we don't think anyone's raising interest rates anymore, or at least not in Australia or the US. Now, if we can get this to load, if we switch across to TLT, TLT is a fund that owns 20 and 30-year US government debt. So the longest duration US government debt. And if we zoom out to a 5-year chart, so keeping in mind, because they've been jacking interest rates up, that has caused the price of bonds, the price of government debt to collapse to in historic terms, we've never seen long-term debt collapse to this extent. And if you go back to 2020, when governments were setting interest rates at zero, printing trillions of dollars, and of course, when they quote print money, when central banks like the RBA or the Federal Reserve quote print money, the mechanism by which they print money is they create dollars or euros or yen, they create those in their computer and they buy government debt, because when they buy the debt, they push down the interest rate. Interest rates are not a dial where they can just tell the world, you will loan the government money at this rate. That's not how it works. They go into the market and they overpay for these bonds. So they push up the price of the bonds to push down the interest rate because they operate like a seesaw, if that makes sense. So when they started jacking interest rates up, or when the market anticipated they were going to jack interest rates up, they caused the price of US government debt in 20 and 30-year debt to go down 51% in price. But in my opinion, we're starting to see now that the debt sell-off is done. I think it was in fact, I won't draw these angled lines, but you can see I've shown this many times before on many charts, the price making a lower low and the momentum indicators diverging, making higher lows. You can see it was kind of trapped in this little downtrend there and then breaks out. If we zoom in, you can see breakout, bounce along the roof, and now it looks like we're heading back up. And if they're going to be cutting interest rates or not raising interest rates again over time, this will drift back up in price, in my opinion. Now, keeping in mind, some of you watching this may not be clients. I cannot give investment advice. If you're interested in looking at what you can potentially do, please reach out for a personal, private chat. This is not investment advice. We're just looking at market data. If we come across to, and maybe I'll close that window so we can try and get some relief on all these active charts that are slowing down the system. If we come across, let's look at a fund that owns the world bond market, BNDW. And if we go to a longer time frame, and my apologies, I know this is frustrating. You can see the same thing. So this is the bottom that we saw in October 2022. And if you're a client of mine, you may recall that I said in October 2022 that I thought the sell-off in bonds was done and that the bottom was in. We saw TLT did make a fresh low, but most bond funds and most bond markets did make their bottom in 2022. You can see there was a retest of that in 2023, late 2023 in October again. My apologies, loading very slow. And now it looks like the bottom's in. We've been going sideways for 2 years and the trend's going back up. So again, that's the market saying, hey, we don't think interest rates are going any higher, which means bond prices need to go back up. They operate opposite. And you might think, well, John, geez, all this news sounds pretty terrible. I mean, the Australian stock market must be under a lot of pressure. I mean, this is bad news. We're already in a technical recession, or sorry, a per capita recession. I'll show you in a moment the mortgage and rental stress that homeowners and renters are in. The inflation problem's not solved. Inflation looks like it's ticking back up. We've got housing shortages. We've got all these problems going on. Geez, the Australian stock market must be under a lot of pressure, right? Well, let's have a look. How's the Australian stock market doing? When it loads, my apologies, I guess the computer runs very slow when it's trying to live record. The Australian stock market has hit a all-time high. this week. And in fact, today it hit another all-time high. So this is a 5-year chart, but let's have a little zoom in and have a look. A little bit of a sell-off in the afternoon, but that's how the market's doing. The Aussie market is up. And this isn't really a charting video, but you can see that there was a little bit of a consolidation from about, what's that, March this year. A little bit of what you'd call a consolidation pattern. If I can get that to draw. My apologies. The computer's not going to play ball, but you can see it was in a little bit of a consolidation pattern break. Here we go. And a breakout, a return to the scene of the crime. It broke out, it came back down to test support, and then it's gone on to make a fresh high. So again, I'm not calling for the Aussie market to just boom, boom, boom. I think we should be very cautious here. It's at an all-time high, which means it is expensive as far as we know. Yes, it could keep going higher. But all this bad news is making markets go up, and it just goes to show the markets aren't really based on traditional fundamentals. It's based on what are they, it's all being manipulated by central banks, by government. What are they going to do with interest rates? If they don't have to raise interest rates anymore, if they're going to let inflation run out of control, well, stocks are prices too. Up go the stocks. So Aussie market making an all-time high. If we come across here, this is a Federal Reserve interest rate watch tool, so we can see what the market is pricing, based on derivatives contracts trading in the market. What does the market think the Federal Reserve is going to do? Are they going to raise rates? So they had a meeting last night while we were sleeping, and they left rates on hold, but it was some of the language that the market really enjoyed. That caused quite a rally. And so we saw gold hit a new all-time record high. We saw US stocks pump higher. Aussie market hit a record high today. Bond prices up. So the market is just buy. Inflation's back on, everything up. No more interest rate increases. And the market is now pricing in some pretty aggressive interest rate cuts. And if we come down here and look at the probabilities, we can see that for the next meeting, which is in 48 days' time on the 18th of September, US time, the market is pricing in a 0% chance that they leave interest rates unchanged. There's an 86.5% chance that they cut interest rates by 0.25%, 25 basis points. And there's now a 13.5% chance that the Federal Reserve will do a 0.5% interest rate cut in 48 days' time. And we can see that in one of the key interest rates, the US 10-year. In fact, that's going to load the Australian one, which is not what I wanted. I want the US 10-year. Here we go. This is the US 10-year. My apologies for the slow charts on this computer. The US 10-year government bond interest rate is a very key interest rate for the market. And again, like I discussed earlier, if we're seeing interest rates come down or interest rates breaking down on the chart, that means that's the market firstly anticipating that interest rates are going to be cut. And it also means that bond prices are going up. So again, if you're a client of mine, if you're following my advice, bonds are our biggest position. So we want to see this chart breaking down. And as you can see, it made a peak in October 2023. And since then, it's been grinding along this upward trend line. And we're starting to see, if we zoom in a little bit, we're seeing a breakdown. It's breaking down from that trend. So this going down means the price of our bond investments are starting to move up. And again, this is a sign, like the Federal Reserve has interest rates. So if you put money into short-term government debt, in America, you can buy 1, 2, 3-month debt. You get about 5.3% interest. But if you take the risk of loaning the US government money for 10 years, you only get 4.06% interest. So why would you take 1.2% interest to loan them money for 10 years and taking 10 years of risk versus just keeping it in a 1-month T-bill? And the answer is because you're locking in that 4% rate, because you think in a couple of years' time, or maybe in 6 months' time, that interest rates are going to be way lower than 4%. And that's an oversimplification. That would be a 30-minute discussion. I'll finish on one last thing. This is from Digital Finance Analytics, Martin North, whose research I trust. So he does research on the Australian housing market. I think he's an excellent analyst. I disagree with him on outcomes. He thinks real estate, maybe it's unfair to say what he thinks without him being here to defend it. But in a lot of the content of his I've watched, he thinks real estate in Australia is going to crash. So we're going to have lots of deflation. But what he does is he measures rental stress and mortgage stress. And this goes back to the year 2000. So stress is defined. So if someone's in stress, it means that their expenses, so money going out, their costs are higher than money coming in, so their wages. So if you're earning 50 grand a year and you're spending $55,000 a year, you're in stress because obviously you can't continue that indefinitely. At some point, you either have to earn more money or spend less. And rental stress is that's 2020 there. So February, he's labeled that on the chart, February 2020. Rental stress, about 32% of renters were in stress, meaning that their costs were higher than their incomes. Look at where it is now. It's at 77% of renters. So the majority of renters in Australia, according to this research, are in rental stress, meaning that they're spending more money to live than they're earning. So they're either depleting savings, borrowing money from somewhere, racking up debt, racking up credit card debt, doing afterpay, zip pay, et cetera, et cetera. 77%. So, and then just have a look at how it was. Look at the GFC. That was in 2008, the global financial crisis. Rental and housing stress was about the same. It was about that line is 18%, so call that 20%. 20%. Look where it is now, 77%. And then mortgage stress, so people own a house, and well, you don't own it, the bank owns it, but you're paying off the mortgage, 50%. It's never been this high. So this is one of the reasons why the RBA is probably too scared to raise interest rates and why they were so slow to do it. Um, Australians are broke on average. I know some people, you might say, oh, I'm doing well, John. What are you talking about? On average, when we look at the data, the average working person, they are in trouble. They are in stress. And that's with interest rates at 4.35%. Imagine if the RBA had to raise to 5 or 6%. I mean, there would be hundreds of thousands of people that would have to default on their mortgage, sell their house. You know where that goes. So um, take note of that chart and how it factors into, you know, if you still think the RBA is going to raise interest rates further to fight inflation, this would be uh, exhibit number 17 as to why I don't think they're going to do it. So anyway, we've covered a lot of things there. I hope that was informative. Please reach out if you'd like to delve into any of these topics in more depth. I have sort of glossed over them in the interest of keeping the video short. Thank you for listening, and hopefully I can give you a valuable update again soon. Cheers.